Ever wondered what is the best investment structure for property investing? Whether should you be investing in your personal name or a trust or a company? This is the common question that I typically get from people who are beginners. Are you a beginner? Are you looking at entering in a property space? And you're wondering, should you be investing in your name or should you be investing in a company or a trust? So I always give a simple answer to this. Say it depends. A context is very, very important, guys. A trust is not suitable for everyone, and that's very important. Equally so, a company is not suitable for everyone. Equally so, it might not be beneficial to invest actually using your personal name. Now, let's break it down. You will agree with me, you and I have got lifespan, which means that at some point we're going to pass on. Unfortunately, that's a reality. Therefore, you might want to ensure that to avoid family squabbles, you structure it in such a way that you don't want to put assets in your name, or for that matter, you also want to minimize the tax implications because you'll agree with me that if I'm working and I'm earning salary and I'm also adding more properties, the probability are that the extra income is going to be take me to the next higher tax brackets, which means that I'll be taxed at the high. So that could be the reason why someone doesn't want to invest in their personal name. Now let's then look at someone can say, but I want to invest in the company using a company. Then companies, as we know, then they'll be taxed at 27%. Now let's take another flip coin of someone who's exposed into higher risk environment. And that particular person can say, listen, Shilo boy, I could potentially be sued because of the nature of my profession. Or for that matter, I could divorce. And then this could result in my divorce bringing all these assets that I own, including the shares in the company. Therefore, I want something that will separate me from the risk. This is where a trust comes in because if a trust administration is done efficiently, it can actually protect you from such scenarios, provided you comply with the trusted, you comply with the Trust Property Control Act. You make sure you actually don't do things that you're not supposed to be doing when you've got a trust. It can actually preserve wealth from one generation to the next generation. Because why? Some people get married unintentionally, so they end up getting married in community of property. Next thing they divorce, and next thing the whole wealth that they've worked hard for, it actually end up being part of the divorce settlement because you didn't know that if you marry in community of property, if you divorce or at death, all these consolidated assets have to be split between the divorcees, right? So that is very, very important. Also, those type of things. So it needs to be a conversation that we need to have to say, why do you want that trust? Why? I mean, let me give us another scenario. You may find that you're looking after someone and then you just want to have one or two properties that so that you can distribute money to that particular person. That might depending on your circumstances also, we might have to consider to just having a trust. But you also need to be mindful of the cost that comes with all these structures, the trust companies. There are certain compliance costs that you might want to hire accountant like ourselves. You might want to hire independent trustees to act as independent trustees for a trust. Those are some of the things that you need to be mindful of. Of course, if you've got assets in your personal name, we all know that potentially because we still have to do the assessment, potentially you might be subjected to what you call an estate duty, right? If you've got a certain amount of dutiable amount, you might end up being subjected to dutiable estate duty. That might not be an ideal situation, right? It might not be ideal for someone else. Also, you want to ensure that there's a smooth continuity of a family because all we know that once you pass on, your deceased estate gets frozen. Therefore, there must be an executor that gets appointed to wind up the estate. During that process, it could frustrate the family. So some people prefer that even when they passed on, the lifestyle that the family is accustomed to, it's actually in a continuing. Hence, some people consider having inter vivos trust so that all the business and everything that they had doesn't get frozen at death, but then it continues running as if nothing actually existed. all you need to do is just to remove that particular person from being a director or a trustee, and then the remaining people can continue running the business as usual. So those are some of the consideration people, when we normally sit down with a client and do estate plan, we ask you, we challenge you. Why do you need a trust? Why do you consider trust to be a viable tool for you? Why do you need a company? Do you know that if you own a company, the shares are going to potentially be part and parcel of the whole estate? They might be subjected to estate duty. So those are some of the discussion that we typically, you might end up having to pay capital gain tax should you pass on if you own those shares. Those are discussions that we need to have with you and sit down with you and discuss these issues with you. And that's why, guys, it's so important to have to do estate planning on a regular basis, because circumstances changes. You might create wealth. You may find that you don't have sufficient wealth to consider having a trust. I mean, I always tell people that someone who doesn't have more than 5 million of wealth, you shouldn't really be having a trust, to be honest, right? But if you've got potential to be creating such a huge wealth, you might want to consider having a trust, because then there's more added benefits. And I've got my reasons. I mean, for you to know my reasons, then you need to sit down with me why I'm saying that. That's my personal opinion. Of course, there's someone else who can say, listen, I've got a trust. I need it from the day one. That is their personal, but that is my experience. That is my opinion. And then someone else can have a different view. And that's okay. That's why there's no wrong or wrong. It depends on professional expertise and someone exposure on what is more relevant for clients. Of course, there is always a solution for different things. If you've got those one or two properties, you could come up with different policies. Some people consider policies that brings liquidity should they pass on. Such policies can end up paying things like those administration costs that include estate duties, that includes capital gain tax, that includes the final tax assessment, income tax liabilities. You see, there's a lot of mechanism that one can consider before they actually decides whether trust or a company or investing in their personal name, it's actually ideal. So you also just need to consider your circumstances, and that's very important. Should you want to do all this assessment with us, you're more than welcome to use the details on my profile, and then we'll definitely attend to you. Okay, good luck.